Welcome to this explainer. Listen, I want to start off today by revealing something that I like to call the index fund trap. It's this entirely invisible trap that just quietly drains your wealth, and honestly, almost all beginners fall right into it. The crazy part? They don't fall in because they picked terrible companies or, panic sold during a market dip. Nope, they fall in simply because they picked the wrong ETF. And the most frustrating part of the whole shebang is that the wrong one looks almost identical to the right one. So today, I'm going to give you 3 really simple filters to spot the difference. To really understand how sneaky this trap is, let's look at a little story. Picture 2 investors. They're both 25 years old, and they are both doing the exact right thing by starting a strict monthly saving routine. They're setting aside $200 every single month. Obviously, they both feel incredibly smart about their financial futures, as they should. But fast forward 30 years. Investor A ends up with a staggering $243,000 less than Investor B. Let that sink in. Investor A didn't make a single bad trade. They didn't even touch their account. They just fell into the trap. So you really have to ask yourself, what exactly is the index fund trap? And what on earth causes this massive financial gap? Well, it all comes down to how we actually choose our investments. When people hear that they should buy index funds, they usually just open up their brokerage app, search for a familiar name, look at what performed best last year, and boom, hit buy. They're picking funds based on what they sound like and completely ignoring the hidden mechanics operating underneath the hood. Okay, let's fix that. Filter number 1, the hidden fee trap. As a general rule of thumb for long-term saving, and think of me as your financial mentor here, before you ever look at a fund's past returns, you absolutely must check its fees. This fee goes by a very specific name, the expense ratio. It's basically the annual cut a fund takes just for the privilege of holding your money. Think of compound interest over a 30-year saving period as this massive rolling snowball getting bigger and bigger. The expense ratio, that's a hot sun beaming down on it, slowly melting your snowball away before it can ever reach its full size. Because of that, your golden rule is this. Your expense ratio needs to be under 0.2%, period. If you look at a fund and the expense ratio is sitting at 0.3%, 0.5%, or anything higher, immediately move on. Seriously, do not pass go, just look for another option. Let me show you exactly why this tiny fraction of a percentage point matters so much over time. The math here is just absolutely brutal. If you're saving that $200 a month at a historically average 7% return, and you have a tiny 0.07% fee, you end up with over $243,000 in 30 years. Not bad, right? But if you choose a fund with a 0.75% fee, which honestly sounds perfectly harmless to most beginners, you only end up with $197,000. That seemingly tiny fraction of a percent literally destroys your compounding interest as the decades roll on. That is $46,000 completely gone. Poof. And here's the kicker. It wasn't lost in a stock market crash. It wasn't due to bad luck. It is literally just invisible fees quietly siphoning off your hard-earned money while you sleep. Oh, and if you accidentally stumble into an actively managed fund charging something like 1.5%, run that same math and you lose well over $100,000. Check the expense ratio first, always.
All right, moving on to filter number 2, broad market versus sector funds.
Listen, avoiding high fees is absolutely crucial, but it's only the first step. You also have to avoid the trap inside the trap, which is chasing narrow sectors. Back in 2023, technology ETFs were up over 50%. And man, it is so incredibly tempting to look at that volatile sector and say, yeah, I want a piece of that. But what you're actually doing is buying last year's winner. When the market trend eventually rotates, and it always does, sector funds can fall just as fast as they spike. Broad market ETFs, however, like those tracking the S&P 500 or the FTSE All-World, they give you stable exposure to hundreds, sometimes thousands of companies all at once. Think of it like this. Buying a sector fund is kind of like going to a restaurant and betting your entire monthly savings on one specific dish. If the chef ruins it, you go hungry. Buying a broad market index fund, on the other hand, is like buying the whole buffet. If one dish, or one sector of the economy crashes, the dozens of other sectors on the table carry you through. That is exactly how you sleep peacefully at night while building serious long-term wealth. And that brings us to filter number 3, the power of accumulating funds. Now, this final filter is frequently the most overlooked by beginners, hands down. It focuses entirely on what happens to your dividends. There are basically two types of funds: distributing and accumulating. A distributing fund pays out your dividends in cash. And yeah, it feels really nice to get a tiny little cash deposit in your account, but it completely halts your momentum. An accumulating fund, however, automatically takes that cash and reinvests it directly back into the fund for you. This tiny structural difference builds absolutely incredible wealth over time. Think of an accumulating fund as a fully automated factory. When a dividend is generated, it's like a tiny new worker. Instead of sending that worker home as a cash payout, the accumulating fund instantly hires them back into the factory to work for you. They just start compounding your returns 24 hours a day, 7 days a week, without you having to lift a single finger. Your snowball just keeps growing faster and faster. So how do you practically spot these automated factories when you're scrolling through your brokerage app? Well, it's pretty simple, actually. You want to look for tickers that end in the letter C or have ACK somewhere in their name. For international investors, a fund like VWCE fits the bill perfectly. For US-based investors, funds like VOO automatically reinvest by default. These are the engines you want driving your portfolio. Let's wrap this up with your 30-year wealth plan. We're going to bring all of this together into one cohesive, simple plan. Before you buy a single share from now on, remember to run it through your 3 filters. 1, ensure the expense ratio is under 0.2%. 2, buy the buffet by choosing a broad market index. And 3, choose an accumulating class fund, so those dividends are instantly put right back to work. When you actually apply those 3 filters, here is the magic that happens. If you start at 25 and invest that $200 a month at a historically conservative 7% return, you hit $243,600 by age 55. But if you can push your monthly savings up just a little bit, let's say to $300 a month, following these exact same rules, your nest egg grows substantially. And if you can manage to aggressively push that saving habit up to $500 a month, applying the exact same 3 filters in the exact same kind of broad market accumulating fund, you end up with a life-changing $609,000. That isn't from timing the market, it isn't from getting lucky on a hot stock, that is purely from applying the filters once and letting 30 years of compounding do all the heavy lifting for you. I really want to leave you with a final piece of mentor advice to lock this mindset in. The habit is what matters. You don't need the perfect ETF, you just need a good one, and you need to stay consistent. Decades of compounding, protected by low fees, are the true secrets to success here. Don't chase the perfect trend, build the perfect habit. So I'm going to ask you right now, literally pull out your phone, open your brokerage app, and check your own portfolio. Are you currently sitting in a distributing or an accumulating ETF? Have you actually checked your expense ratios lately? Take control of those hidden mechanics today, and trust me, your future self will undoubtedly thank you.